Hello everyone, this is Professor Simi Rakshit, associated with Swami Vivekananda Institute of Modern Science, Kolkata. Today I am going to discuss about a very important topic, and the name of the topic is cost of capital. At first, we will learn about the definition of cost of capital. Cost of capital is the rate of return the firm expects to earn from its investment in order to increase the value of firm in the marketplace. In other words, it is the rate of return that suppliers of capital required as compensation for their contribution of capital. So cost of capital refers a minimum rate of return to the suppliers for their contribution or for their investment of capital in a particular organization. Next topic under cost of capital is source of capital. So there are different types of sources are present, and by these sources an organization can collect its required amount of capital. So there are some sources, mainly there are four types of sources by which an organization can collect its capital. So first one is here equity share capital, second one is here preference share capital, third one is debt, means debt capital, and the last one is retained earning. We have just learned about different sources of capital. So an organization can collect its required amount of capital from any sources, means it's from equity share, it's from preference share, it's from debt capital, and from retained earnings. So when an organization will collect this capital from different types of sources, means by using any sources of capital, then the organization will pay a particular amount of return to the contributor of capital, who is called as suppliers of capital. And there is a method for calculating this return, which is called as cost of capital. So now I am going to discuss about this, the calculation process, means how to calculate the capital. So here there are some techniques or method by which we can calculate this. So the first method is computation of specific cost of capital. So let's see what is specific cost of capital. Specific cost refers to the cost which is associated with the source of capital. Example, cost of equity. Computing specific cost of capital involves summing up all forms of capital listed below. So here the first one is cost of debt, second one is cost of preference share, third one is cost of equity, and the last one is here cost of retained earning. So by this, so we can calculate cost of capital for each and every sources, and by summing up or by the adding up all sources, means by adding up cost from all sources, we can ultimately get the answer, means get the value of cost of capital and get the value of minimum rate of return. Another method for calculating cost of capital is computation of composite cost of capital. Composite capital is the combined cost of different sources of capital taken together. It is also called an average cost of capital. Now I am going to discuss about cost of debt and the calculation process of cost of debt. So first of all, we need to learn what is cost of debt. The cost of debt is the rate of company pay on its debt, such as bond, debenture and loans. So if a company collects its capital from debenture, from bonds or from loan, then the company will pay a rate of return to the suppliers of this capital, and this return is called as cost of debt. Now we will learn about the calculation of cost of debt. So debt may be issued at different modes, that is issued at par, at a premium or at a discount. Debt may be irredeemable or redeemable. Following are the procedure for calculation of cost of debt. So here the first one, so first method is cost of irredeemable debt. So under cost of irredeemable debt, first method is issued at par, means when a redeemable debt will be issued at par, then what will be the calculation process? Then the next one is if it is issued at premium, and the third one if an redeemable debt is issued at discount. Now the second one, so second types is here cost of redeemable debt, and under this the first one is issued at par, then issued at premium, and the last one is issued at discount. Now I am going to discuss about cost of irredeemable debt. Irredeemable debt is the debt which is not required to be repaid during the lifetime of the company. Such debt carries a coupon rate of interest. This coupon rate of interest represents the before tax cost of debt. After tax cost of debt can be calculated by adjusting the corporate tax with before tax cost of capital. The irredeemable debt may be issued at par, at discount, or at premium. The cost of debt is the yield on debt adjusted by tax rate. Now I will discuss about the next topic, means here symbolically we can present the cost of irredeemable debt, which is also called as the cost of perpetual debt. So we can present this cost of perpetual debt by KD, and there is a formula for calculating this cost of irredeemable debt. So let's see the formula. So formula is KD is equals to I by NP 1 minus T. So now there are some unknown terms, so I will talk one by one what are the terms here. So here the first one is I is annual interest payment. Then NP means net proceed from issue of debenture or bond, and the next one is tax rate. So by this equation we can calculate the cost of redeemable debt or minimum return on irredeemable debt. Now we will see the application of this formula, and now I am going to give an example. So here you can see the example. So and after that we will solve this. So here in this example you can see a company has issued 12% debenture at rupees 2 lakh. Tax rate is 30%. So requirements are here. So first one is if debenture are issued at par, if debenture are issued at 10% premium, if debenture are issued at 10% discount. So here three situations are given. So by this situation and by this given information, we will calculate the cost of debt, means cost of irredeemable debt. So let's start. So first of all, we will calculate for the first situation when the debenture are issued at par. So now this is the formula. I have already explained the formula. So formula is KD is equals to I divided by NP into 1 minus T. So first of all we need to calculate the I. So what is I? We know what is I. I is the interest, annual interest rate. So I. So by here the total amount of debenture is 2 lakh and the interest percentage is 12. So by multiplying this we can easily get the value of I, which is 24,000. Now we will calculate the next one, NP. NP means net proceed. So net proceed is here 2 lakh, because here at the first situation here the debenture are issued at par, means here the debenture are issued at same value, not overvalued and not at undervalued. So that's why NP will be here 2 lakh. Now the next one is T. T is given, which is 30%. So 30%, that is 0.3. Now we will put this value in this formula. So after putting the value we will get the answer. So the answer is 0.84 or 84%. So this is the value of debenture, means this is the cost of irredeemable debt when it is issued at par. Now the next situation is if the debentures are issued at premium. So same formula will be applicable for this situation also. And first of all, we need to calculate I. So I will be saying 24,000. But NP will be changed because here debentures are issued at premium. That means debentures are issued at overvalued. So we will calculate the value. So the total value of debenture is here 2 lakh and it is issued at overvalued. That's why we will calculate we will calculate 110% of 2 lakh, and the answer will be, means for NP, the value of NP means the value of net profit will be 2 lakh 20, and T is the tax rate which is 30%, means 0.3. Now we will put the value in this formula, and after putting the value we can easily get the cost of capital for irredeemable debenture when it is issued at premium, and the answer will be 0.076 or 7.6%. Now here the last situation, third situation is the debenture are issued at 10% discount. So when the debenture are issued at 10% discount, then what will be the cost for this irredeemable debenture? So let's see. So here first we will calculate the value of I. I means here annual interest payment. So the formula will be same and the value will be same, 24,000. Then net profit. So net profit will be changed because here it is issued at 10% discount. So that's why we will calculate 90% of 2 lakh and the answer will be 1 lakh 80. And the last one, tax rate is 30%. So that means 0.3. So now we will put these values in this formula. And after putting this value, we will get the answer. The answer will be 0.093 or 9.33%. Thank you for watching this video. Please like, share and subscribe my channel.